Hi everybody, in this video, another novel policy aimed at reducing inequality, that is wealth taxation. This is a tax on an individual's net worth or their assets rather than targeting their income. So for example, this is a tax that will target an individual's savings, physical property, their financial assets, minus any debts that are associated with those assets. A wealth tax can be progressive, so the tax rate can rise as wealth rises, and it can be set at varying thresholds. This is a common policy across Europe, but there are many countries out there that don't have a wealth tax and are strongly debating it at the moment. So let us engage in that debate ourselves by understanding the pros and the cons, starting with the pros. A wealth tax could be a huge revenue earner for governments. I mean, wealth has exploded over the last 4 decades or so. Globalization has had a large part to play in that, opening up financial markets of countries all around the world. Advancements in technology has also accelerated the growth of financial industries. Rising population has meant higher property prices and land prices. Just generally, higher global income has meant a greater accumulation of savings, a lot of income going into wealth, increasing asset prices. So even a small wealth tax can earn a huge amount of revenue for the government, revenue that can be used to run down budget deficits, reduce national debts, improve the sustainability of government finances, especially if government finances are in a bad way. The revenue from this tax could be very useful in improving the state of government finances. But this revenue coming in, of course, can be used to fund public services like healthcare, education, public transport, infrastructure, a big benefit for the government there, of course. Naturally, this policy directly can reduce wealth inequality, but also can reduce income inequality. If the revenue generated is used to fund health or education, or more directly used to fund benefits, there's the link to lower income inequality. And by reducing inequality, you overcome the major issues associated with rising inequality. If I isolate 2 in particular, rising inequality could mean undue influence on politicians, politics, policies, which is not a good thing. But also a greater concentration of income or wealth among a small fraction of the population can reduce equality of opportunity for others in society. Dangerous, not what you want. So you can overcome those 2 major concerns as well as all the others of rising inequality if this policy helps to generally reduce inequality in society. A well-designed wealth tax can also target windfalls. In this case, that means an unexpected rise in the price of an asset. Now, assets can rise in price for a wide variety of reasons. A lot of those reasons can be productive. So, for example, share prices can go up because businesses have made brilliant decisions about how they run their business. Maybe they've spotted gaps in the market. Maybe they're running their business far more efficiently. Maybe they're making their own investment decisions, which are all leading to higher profitability and higher share prices. That's productive. That's a very good way to increase asset prices. But asset prices can rise for other reasons too that are non-productive in nature. For example, property prices can rise because of strict government regulations, because of a lack of supply or scarcity. Land prices can rise because of scarcity or a lack of supply. Share prices can rise because of greater monopoly or oligopoly power, helping to boost profits that way. These are unproductive reasons for rising asset prices. So a wealth tax that targets those windfalls can promote equity, fairness, but also can mean a more efficient allocation of funds. A wealth tax can also promote a good reallocation of wealth away from low-yielding, unproductive or less productive assets towards higher yielding, more productive assets. So naturally, if a wealth tax is there, people are going to look to invest in assets where they're going to be less burdened by the wealth tax. So they're going to look to seek the most high-yielding assets out there where the wealth tax isn't going to affect them as much. So that might mean moving their money, moving their wealth away from, let's say, low-yielding government bonds or savings in a bank account where the interest rate is quite low, to funding startups or going into shares where the potential yield, the rate of return, is so much greater. And that reallocation of wealth can help to fund business growth, can fund entrepreneurship, can fund business investment, which maybe contributes to growth, employment in the economy. Interesting point, that one. That's if, again, the wealth tax is well designed. But there are some major cons. If a wealth tax is set too high, it can very much go the other way and promote horrible incentives, discouraging investment, discouraging savings, as people don't want to be burdened by a significant wealth tax. But also businesses are less keen to invest themselves if it means significantly higher profits or rising asset prices within the business that are going to be subject to the wealth tax. But more generally, a high wealth tax can discourage income generating activity. There is a saying in economics where today's wealth is yesterday's income. Of course, you need income in order to have wealth. So today's wealth is prior income. So by taxing wealth very highly, you're discouraging income generating activity that then becomes wealth later. Not a good incentive in an economy that can stoke economic growth, harm employment, and actually ruin the incentive structure of an economy. So that is if a wealth tax is set very strongly. You've also got your other classic Laffer concerns of the high wealthy in particular, leaving the country, emigrating, moving to countries where a wealth tax doesn't exist. You've also got the risk of very high wealthy individuals finding loopholes in the tax system, either themselves or through an accountant, which they can easily fund, and therefore look to evade paying taxes or avoid paying this wealth tax. These two issues can limit then the revenue generated for the government by a wealth tax. And then you've got the administrative challenges of taxing the right assets and also valuing assets, which is a hard thing to do in reality. If this isn't done very well, then that can reduce the effectiveness of the policy in giving us these major pros. So we can see that the trade-offs with the wealth tax are very, very significant. A lot can go wrong as well as potentially going right. So these evaluation points become crucial. For a wealth tax to generate more pros than cons, the rate is crucial. The higher the rate, the more you're likely to get these trade-offs. Maybe more importantly are the assets chosen. A really well-designed wealth tax will target less productive assets over more productive ones, but also will target windfalls more than productive increases in asset prices. But in reality, that is a very, very hard thing to design. It's so easy to say that. Of course it is. Of course that's a really good wealth tax if you're able to do it. But to do that in reality is unbelievably difficult. So the chance of actually getting things wrong is significant. Therefore, the chance of these trade-offs occurring are very significant, very hard to design this correctly. And of course, you need strong enforcement if you're going to bring in the revenue, if the tax is going to be effective overall in giving us these major benefits. So that, guys, is what a wealth tax is and the major pros and cons associated with it. At least now you can engage in a very interesting debate. You understand this hopefully perfectly now. Interesting stuff. So thank you so much for watching. Can't wait to see you in the next video. See you then, guys.